One of the key considerations for any business is what structure you trade through. Now, there's heaps of options, and the right one for you is going to depend on your circumstances and where your business is at. But for e-commerce businesses, we tend to recommend one structure more often than not. And that is that the trading entity is a company, it's a PTY Ltd. It has the income, it pays for the COGS and the expenses, and is left with the profit. That profit's taxed at 25% for most small businesses, and the balance of that is retained in the company. The way you get retained profits out of a company is by declaring a dividend. Now, we say that the best option here is that the dividend comes out to a trust, and that trust then has the flexibility, or the trustee of that trust has the flexibility at the end of the year to choose who that income is distributed to. Now, you might distribute some to yourself, to your spouse, to adult children, maybe to some extended family members, or you might choose to park some of it over in another investment company at 30% if you're really looking to sort of manage your tax liabilities. The reason for the trust is that you get this flexibility to distribute the dividend. If you held your company shares just as an individual, then it doesn't matter whether that dividend's $1 or $1 million, that's coming out to that person and being taxed in their name. Now, if you've got a lot of income, potentially that's a 47% tax rate, and you're going to give a bunch of your money to the government. So the trust structure gives us some flexibility to choose how that dividend is taxed, rather than being forced to tax it in an individual's name.